In this episode, we speak with Nelson Chu, founder and CEO of Percent, which is unlocking private credit and providing unparalleled access through its modern private credit market, empowering investors, borrowers, and underwriters with innovative technology to increase the speed and frequency of transactions at a fraction of the cost. Founded in 2018, Percent's platform is becoming the market standard for asset-based and corporate lending, powering over $1 billion in transaction volume in a multi-trillion-dollar private credit industry. Prior to Percent, Nelson founded a strategy consulting firm named Lumenary and co-founded MySupport, an online platform that helps seniors, people with disabilities, and families connect with direct support workers. I'm your host, RJ Lumba. We hope you enjoyed the show. If you like the episode, click to follow.
RJ Lumba is the executive chairman of Market Insight Media and the managing partner of Growth Cap. He is the host of Great Entrepreneurs, a podcast for driven entrepreneurs and business owners. Our podcast covers all topics related to the entrepreneurial journey, from ideation to execution to optimization and to reaping the rewards of a well-run business. In the minutes ahead, we'll share with you unique insights and tactics from some of today's most accomplished and inspiring entrepreneurs.
Nelson, thank you so much for taking the time to chat with us today. It's a delight to be with you.
Yeah, thanks for having me.
So the space you're in, private credit, is near and dear to my heart, and particularly the way you're approaching it, where you're trying to open up access to all the potential investors as well as borrowers. How did you come up with this idea? It's a pretty big market and opportunity to approach. How did you first come up with the idea?
Yeah, I think a lot of ways it's always accidental. It wasn't intentional by any means. So when we started this company in 2017, 2018, we were looking at the investment landscape that was out there, all these different alternative investment platforms. And we were seeing a lot of things that were like startup investments or real estate or collectibles or anything like that. And we saw an opportunity to just do something better, right? A lot of these opportunities were super long duration. They were like multi-year lockups. The minimums were really high. It was like 25, 30 grand. I'm just thinking to myself, do I want to give a startup like 25, 30 grand and have it locked up for 4 years? That's crazy. So why don't we come up with a investment product that's super short duration? So maybe like 1 month, super low minimums, like $500. And if our yield is similar to everybody else's, which was like 9 to 16% at the time, then we might have something super compelling. So it was actually born out of something that I wanted to solve for myself because I thought investors would need that. And actually, believe it or not, the only asset class that fit that bill was private credit. So we were saying, okay, this is kind of a new asset class to us. We're not that familiar with it, but who knows? Let's at least use this as a starting point. And then where it takes us is where it takes us. And we had no idea that private credit would become so hot, probably one of the hottest asset classes in finance right now. And I think sometimes you got to be lucky. So we've been lucky along the way to take advantage of a lot of those tailwinds.
And typically when these ideas come about, there's multiple parties trying to do the same idea or similar. And, maybe it comes down to execution. Maybe it comes down to a slight nuance to the approach to the market or, a segment of the market. Can you tell us a little bit about the landscape when you first started? I believe there were a couple other credit type platforms out there.
Yeah, I think one of my mantras is always stay business long enough to get lucky. And so I think we've definitely been around long enough at this point to get lucky, and we've taken advantage of that. But to your point, yes, there were other platforms that are out there. Actually, a lot of them were multi-asset class. So the goal was to democratize investments for all, right? Any sort of alternatives, whether it's real estate, private credit, litigation finance, startups, you name it, I'm going to shove it all in one platform, and then you can have your picking and choosing. And while that, I think, works for investors who are looking for just one-stop shop, the reality is, as a specialist, you tend to do better, right? Because it is all that you eat and breathe every single day. You know how to build tooling, you know how to build lots of different services that are just tailor-made for that asset class. And private credit is pretty unique. It's kind of a weird asset. There's a lot of things that are very esoteric, very unique to how they operate that no other asset class does or needs. And so unless you really go deep on it, you kind of run yourself into trouble. And we've seen that happen in multiple different other platforms where they just likely were just multi-asset class, multi-specialists, in which case they're just not that good at certain things. And I think we've done well to just be known for one thing and one thing only. And when people think private credit and alternative investments, they think about us. And that makes it really easy for us to be able to just have our brand stand for one thing.
Mm-hmm. And the one thing, sitting in your shoes as you're founding and getting this kind of platform off the ground, the one thing you're probably worried about is like these assets have to perform, right? The investor has to make money. And it can't be a situation where there's this imbalance with the loss ratio. So, how did you manage through that to ensure that the investor would indeed receive the return they were expecting?
Yeah, I think this is a lot of learning by doing. That's the only way to figure it out, right? And I think our vision is to really transform private credit from just a niche, alternative, esoteric asset class into something that is on par with the likes of public credit, right? So like your public fixed income markets. And to get there, you need a lot of things in place. So you need market standard deal structures, you need standardized reporting, you need all these participants being able to find each other on a single platform and be able to trade with each other. So those are all things that we knew we had to get to. And unfortunately, or fortunately, the only way to do that is to do it yourself. And so for the first 4 years of the company's life, we actually did all of the credit underwriting for 400 plus deals worth about $1.002 billion, right? So that is a metric ton of volume over the course of a very short amount of time. And in doing so, we just figured out how we could potentially be making mistakes and how we can get better and smarter, how our clients could potentially be taking advantage of us and how we mitigate against that. And so all those things helped us get smarter and smarter so that the structure that we put in place by the time year 4 came around looked completely different from the structure in year 1. And the truth is, yes, we did have some defaults along the way. We had some recovery along the way as well. But the performance, especially in recent years, is a testament to how much smarter we've gotten to be able to better protect investors. And that shows up in the performance of our returns to investors. So the last 2 years, 2023 and 2024, we returned between 14.5 and 14.6% net of charge-offs to investors, which is pretty good in this environment. So we'll take it. But that performance is significantly better than it was in the beginning when we first got started.
Now, to the universe of founders out there or, aspiring entrepreneurs, you're operating in a place that's probably one of the more complicated areas. Tell us about your background and how you were able to develop the skill set to do such a complicated type of endeavor.
Yeah, complicated is an understatement. Tell that to our VCs who invested in us are still trying to wrap their heads around what we do. So I think there is a bit of naivete going into this that actually made it possible. So my background, while yes, I did spend my 2.5 years in traditional finance, I learned nothing about finance in those 2.5 years. I did a lot of Excel, did a lot of PowerPoints, and not really anything deeply within financial services, especially on the operations side. So definitely wouldn't call myself in the finance space. I had left that to do my own thing and start a consulting company that helped other founders build their startups from the ground up. Everything from product to marketing to branding to engineering. And that gave me an actual crash course in how to build companies, seeing other founders build their startups, mistakes that they made, things they did well, and just kind of acquired that knowledge over the years. So I went into this with very, very rose-colored glasses about this is such a broken industry, so tech backwards. All it needs is just a little bit of tech and it'll be so much better. And I think in having that mindset, it changes how you approach things and it makes you believe that it is possible. Because if I had come to this from a traditional finance, even a fixed income mindset, I think the mentality would be, there's no way you're fixing this. Like, it's just impossible, right? It's always been done on Excel. It will always in the future be done on Excel. People are always going to need to talk to each other and via email. Then they'll set up meetings. Like, that's the only way it's going to work. So our team comes from traditional finance. They come from that DCM, debt capital markets background. I come from the tech side. And I think the two work really well together. There's a bit of a push and pull, right? So you have the ability to say, I want to bring this forward this way. And the other side's like, well, that's not possible. It's like, okay, well, let's meet in the middle. Let's get them halfway there. And then we'll slowly get them all the way there. So it's that dynamic that I think works really well. But if I had come from straight finance and everybody on the team came from finance, I think it would have been a little more problematic because you just would probably not do the things that we had done today.
And when you started that consultancy, it seems like you were still earlier on in your career. Like, what gave you the confidence to say, like, well, I can advise other people on how to build a company?
Yeah, I think when you're broke, you become a consultant. So that would be the answer. And I think, I guess, fast forwarded through was that I did attempt to do a startup before the consultancy, crashed and burned in 6 months, learned just how hard it is to build a company. But I had picked up design skills, picked up pitch deck making skills, picked up sales skills along the way to try and do this. So every single thing that I've done in my life, I haven't regretted it. I've learned from it and I've acquired it to be able to use in the future. And where I am today is very much standing on the shoulders of past experiences to get here. And so that 6-month time frame where I learned a lot, but also accomplished pretty much absolutely nothing was what basically got me off the ground. And the first service we offered for the consultancy was pitch deck work, right? So that pitch deck work, able to tell a good story, able to build a financial model, did some half-baked designs that were better than others, I guess, at that point in time. When these companies kept raising money off these pitch decks, they started asking me, like, can you do website design services? Can you do mobile app design services? Can you introduce me to VCs? And I think the answer was like, yeah, I got all these people that know how to do all this. It was just me. And then you end up building a team around that to be able to support it. And we got more and more sophisticated over time in our services to almost basically offer like an MVP in a box, essentially. So you have an idea. Hopefully you've exited a company before, so you can pay us because we weren't that cheap. And we can just give you the team without hiring it at the outset, and you slowly staff us out as you raise more money.
Did you show signs of entrepreneurship early on in life during your childhood?
I did. Yes, much to my parents' chagrin, I guess. But my dad was actually a founder. So he had co-founded a company, a software company with a bunch of his friends in central New Jersey. I think it was in a very niche space as well. And so he was always very encouraging of me to tinker and try new things. My mom, probably less so. She wanted me to go down the doctor, lawyer, banker path, would have made her very, very happy. Just less risk, I guess. But yes, so I think in doing so, I was always tinkering with stuff. I had bought myself a Mac in 1999 before nobody had a Mac in 1999. I taught myself Photoshop, taught myself movie making. I pretty much did everything that wasn't academic related. And that creativity, I wish I still had a lot of that today. I think it's faded as you get older. But it was really doing that and not listening to my parents, just doing my own thing that I think made me destined for learning very quickly that corporate isn't for me. And also that I'm a really bad employee because I don't usually listen and I will do it my own way. And then, whatever happens, happens. So it's always been leading down this path.
And right now, where you are with Percent and building the company and taking it from where you are today to where you want to be, say 3 years from now, what is the thing that you're working on personally about your own skill sets?
Yeah, I think what's been interesting is the needs of a company when you're 5 people as a CEO that change very quickly from when you're 15 people to when you're 25 to 50 to 100. And then once you pass like 250, it kind of is about the same. I can't say that now because we're not 250, but I'm assuming it's different, but still similar because you're scaling a large organization, right? And so in terms of how to like manage people, the culture you have in place, all those different things. So I've learned a lot along the way in terms of how to build transparency within our culture, how to be a better leader to the team to make sure that they're always motivated, inspired by the vision that we have. And so I've done a decent job of the 40-person team that we have right now. At our peak, we were actually closer to 80. And so with all the things that happened in 22, 23, et cetera, us, like most of the companies, were forced to downsize. But we took a lot of things that we learned as an 80-person company and brought it down to a 40-person company, which made us significantly smarter about how we operate the company on a day-to-day basis. There's things that I do want to get better at in terms of actually having a longer-term time horizon and looking at the company. I think the way that we've grown now, we're not perfect, but we're a lot more stable than we were in year 3, year 4. There's a foundation of revenue and a foundation of an underlying business that we can lean back on. And so given all that, what used to be like, let's just plan for the next year, right? Let's just figure out what it's going to look like by the end of 2025 or the end of 2026. And that's all we can see right now. It does benefit us to have that 3 to 4 year time horizon to be able to understand how to make adjustments in the org, in compensation structures, and just being more forward thinking. Those are bigger company problems that require, bigger company leadership. And it's just on me to rise to the occasion and get there. But in many instances, this is just, you have to experience and go through it yourself and then learn from it. And then now it's part of your arsenal of things that you can pull from to be able to apply to the organization.
When you're recruiting and hiring, if there's one thing that when you see it, you immediately want to go after that person and bring them into your organization, what would that one thing be?
I think it's being curious, having that sense of like wonder still about things, right? So, and being passionate about something. One of the questions that I always ask is like, obviously, if you join a startup, it's the hope that it does really well, that you're financially set and all of that. So the question is, if you join Percent, the company does really well, and you actually don't have to work anymore, what would you be doing with your time, right? And I can tell you, if I get the answer that they're going to be traveling, That is a full stop no. It doesn't work for me. Sorry. Like, and anyone's listening to the interview right now, like, or this podcast right now, like, just please don't answer that way when you interview with me, because it shows that like they're not intellectually curious. They're not looking for more. They're not looking for something else that drives them, or there isn't anything else that drives them. And so when people come back and say, well, like, if I had all the time and I had all the money, this is what I'd be working on. I hope it's not finance too, by the way, because like, there is so much more to life than financial services and private credit. If they can do that and share what they're passionate about, and then how they even solve that problem with the resources that they now have, that becomes super interesting. And people can answer that, have done very well at the firm, because it shows more depth to them than you'd see in a traditional interview. And a lot of people get taken aback by that question because they probably never thought about it. And so they need like time to process the question and then come up with a good answer, because it puts them on the spot.
But if they have an idea and they show that they have the inclination to start their own thing, does that, maybe you're thinking, oh, they could leave in a year?
But that's okay at the end of the day, right? I think like everyone, in the same way that I left finance at 2.5 years to try and do my own thing, I encourage that. And I think if they can take the things that I or we as a company can teach them, and it helps them get them on their journey to do their own thing, that's like the best case study, and that's the best testament to what we do here as a company, that we can bring that out of people. I love it. And we've actually had, not just in this company, but in the consulting company as well, some of the team members went off to do their own thing, and I'm the most proud of them, right? Because like they look back on the time that they had with us fondly, and it would help them get there. I'm super encouraging of that. So they're obviously extremely talented. They'd be great team members here for the time that they're here. And then when they're ready to go and I guess leave the nest, if you will, then like by all means, I hope they do it. And I'm there to support them every step of the way as an advisor if they ever need the help as they think through their business model, how to scale, things like that.
Back to the platform. So if I'm a regular person out there, I'm trying to allocate my portfolio, be better at investing. Say I have a target yield of, I want to make 10% a year across the portfolio. I've got a ton in, S&P 500, these various ETFs, but I'm really interested in private credit because it can get me 15%. How easy is it to get started on the platform and start just allocating money into it? How fearful should I be that this may not pan out? I know it says 15%, but what if I end up with zero?
Great questions. So a couple things there. Private credit should not be the only thing invested by far, right? Definitely don't recommend that. But can it be a important part of the sleeve of your alternatives? Absolutely. And you're seeing that in family offices and RIAs, registered investment advisors. They're allocating roughly 10 to 20% to alts, and private credit makes up 10 to 20% of that, right? So that's wonderful. I think in the same way that you diversify your returns on the equity side through ETFs, you should probably diversify here as well. Don't just put all your eggs in a single private credit issuer. So for the platform, it's really easy to get started. We actually let you sign in with Google, and then you can see all the deals. So it's actually very, very simple. No identity verification, no accreditation or anything until you actually want to make an investment, right? So you can see everything, all the historical data, all of that. We were founded on the belief that you should have $500 minimums to try before you buy. And there are usually $500 minimum investment opportunities at any given point in time on the platform, just to be able to you can understand how it works, put a little money to work, see what comes back. But we do have something for everybody, right? So there are no shortage of investors who love to pick and choose their own thing. If that's your jam, by all means, go for it. I think you do want to diversify. We've seen some people go heavy on one or two things, and it's like, yes, they're doing well right now, but you never know. So like you should still try and, spread it out. So direct investment, always a possibility. As you get more comfortable with the platform, we do have something called a blended note. And a blended note is literally what it sounds like. There's a basket of things in there that you can get exposure to. If you're a regular retail credit investor, we will pick the theme for you. So it could be total market. So every deal that comes out over the next 12, 24 months, you'll get exposure to. There could be US only. It could be senior only. Like always, every single month, there'll be one of those themes available to invest into. If you're a family office or you want to put more money to work in private credit, we can do what's called a bespoke blended note. And so that's the same concept, but you tell me what you want. So you can create your themes, and then we'll create that product for you. And then we also now have a fund. So registered investment advisors, RIAs, tend to prefer investing to a proper fund and not a managed product that's on some random platform, not directly into deals. So those institutional investors tend to be able to invest through the fund vehicle and not through any of these other products we have directly on the platform. So the answer is something for everybody, but try before you buy. Low barrier to actually get started. And then you can see everything just by signing up.
And how big could an investment be?
I think the deals themselves have a certain limit because a borrower can only take as much money as their portfolio of loans can allow for, right? So if there's, for example, a $10 million loan portfolio, we may only advance 85% of that. So the max we can raise is 8.5 million for that because we're not giving them the entire amount, right? So it just varies case by case. But when it comes to like the managed products, they can go as large as you want it to be because it's just diversifying into lots of different opportunities. Oftentimes by the end of it, it'll have gone through 20, 30 investments, if not more.
And this is high yield. So what are the underlying assets?
Yeah, so we have done both what's called asset-based finance and also just regular corporate lending. And on the asset-based finance side, you're essentially giving money or financing a loan portfolio. So these are going to be small business lenders, consumer lenders, factoring companies, people that have hundreds of thousands of loans underneath there, and they're getting money to be able to grow that portfolio. So your exposure when you invest $10,000 is going to be in tens of thousands of loans. You get a little portion of that, right? In the corporate financing side, that is literally just one borrower. You're giving them money for working capital financing, for buying equipment, like whatever it is that they need. But the risk obviously is higher when there's a single borrower versus a portfolio of loans that you're financing, right? So the yield is higher on the single side versus the loan portfolio side. And these are borrowers that are in the US, in Mexico, Canada, Latin America, overseas, like all over.
Mm-hmm. I'm sure what everyone loves to ask about is, well, what are the fees like? Obviously, like people should just look at the net, right? Because if they're happy with the
Sure.
net, all things are good, right? But how do you kind of like explain the fee situation?
Yeah, it's pretty easy to understand. So if you are picking investments directly, right, then it's just 10% of the yield. So if this product is yielding 15%, nice even round number, then we'll be taking 1.5% of that 15%. And we take it against your interest every single month. So it's not like it's like one wallop at the end. If you invest in the managed product, that blended note, then there's also going to be another 1% management fee, similar to what you'd see in any sort of managed product, effectively. So on a 15% product, your net would be 12.5 if you invest it through that managed vehicle. But that's simple, easy math, basically. And the total return that we've had for investors, if they invest in every single transaction, like I said in 24, was 14.6%. So that is not bad in the grand scheme of things.
Have you had investors, and I know things turned in year 4 to the better. Have you had investors stay with the platform for over a year, multiple years?
It's usually multiple years. Yeah. I mean, like I was looking back at some of our early investors in 2019, 2020, they're still here and their IRR was like 11%. So that's since 2019, 2020, when rates were significantly lower. And there's a number of investors that have been like that. The reason why they're still here is because some of them, yes, did have some losses and charge-offs and whatnot, but they diversified across so many different things that they can maintain their IRR at that level.
So it would seem that the key driver of this platform is your ability to maintain a high level of quality of your deal flow. And then secondly, I guess it's how you're structuring the deals. You've learned to like structure it in a way where the investor is protected to a certain degree. Would you say that's accurate or am I missing something?
No, definitely accurate. And I think it's just the diversification of deal flow as well, right? If all we ever did was US consumer lending, that's a little bit problematic, right? I think consumer behavior and consumer performance goes up and down all the time. So you marry that with SMB lending, you marry that with Latin America consumer credit versus US consumer credit. Latin America consumer credit, believe it or not, does really well. And I think the loans are $50. So they're very small. You get hundreds of thousands of loans in that portfolio. It'll do well in the grand scheme of things, right? So the ability to pair all of that together and give you that optionality is what drives performance. And when you look at private credit performance over the years, there's a lot of ups and downs and whatnot. But actually, what kills you is usually leverage and not the size of the deal, right?
Mhm.
Size doesn't indicate good or bad performance. I think you can structure most things away in terms of risk, but in terms of using leverage, that has burned you every single time. When it goes south, it goes really south. We don't use that in our portfolios.
Would you say that the talent that you look for the most or you'll pay up for the most is the person who can identify the deals, pick the deals? I presume you've already figured out how to structure most of the deals, but would you say that's like kind of like the people in your organization that you're really focused on?
The person who doesn't like to travel. I'm just kidding. No, it's actually, it's a good point. A lot of them come from traditional finance experience, which makes sense, right? But what we actually look for is the ability to be creative in that instance because nobody has taught you how to do private credit. Like it's so relatively new. It's almost like people saying, I want 7 years of AI experience in like large language models, and it's only been around for 3 years. So like, it doesn't make any sense, right? Same concept here. We look for people who oftentimes have had some sort of underwriting experience. A lot of them come from ratings agencies because they teach you really well there, and they take an extremely, I think, risk-oriented lens on all of this versus like if you worked at the sell side at a bank, you're probably a little more creative, a little more commercial, and like a little more, loose around the edges to be able to get something done. So there's a nice balance there. But to your point, I think when we used to look for someone who had a lot of structuring experience and had a lot of just ability to pick and choose all these types of things and know how to underwrite, these days, like being able to actually vet a deal properly is super important. And the originations team that we have, they've been here for a very long time. So they've seen the different phases that we've gone through as a company. And now before it even gets to our credit team, they have the ability to basically say, this is just not going to fly. Like, I know this is not going to fly. So we're going to just nip it in the bud and not waste anybody else's time, like down on the credit side. So it's a natural evolution of how our organization has changed over time to adapt to the things that we need.
Well, I commend you for what you've been able to accomplish. This is not an easy feat. I kind of know this space. I've known people who've tried to undertake this particular type of venture. Before I head into the last two questions, I guess, could you tell us a little bit about how are you currently growing and where do you see it heading in the near term?
For sure. I think I alluded to it earlier on in the process, but we're trying to make private credit a fully realized institutional acceptable asset class, right? And a lot of things need to happen to make that the case. It's almost 7 years now in May. That'll be our anniversary. And in those 7 years, we built a fantastic marketplace business, arguably wealth management business, given who we target, right? And that's done quite well for us. That'll continue to do well for us. And that actually will bring us to profitability and beyond. It's traditional asset management, multiples, revenues, like all that stuff, right? So nice and wonderful. What we need to get to is what institutions need. And institutions need workflow. They need liquidity. They need all these different things that make tradability happen, that make transactions happen from end to end, and make price discovery and transparency happen. So we've laid the foundation for all that. But instead of doing sub $5 million deals, which is what we historically have done, we need to start doing 25, 50, $100 million transactions where we're not responsible for the capital because those institutional guys have all the capital they need. It's actually more for how we make this all more efficient and how we actually make more transaction volume happen. And that's the name of the game here. So as we scale, we're going more and more upmarket. We're providing more institutional tooling. But the beauty for retail in this marketplace is that they'll be the first ones to get a look at it because that's our sandbox to test a lot of this stuff out. So we are launching a lot of things this year related to price discovery and a lot of liquidity options for investors that will make that possible. And we'll see if they take to it. We'll see what's wrong with the UX that we built, and then we'll move it on to the institutional side of our business that is much more conventional, looks more and feels more like a market data or a capital markets infrastructure company.
Interesting. Yeah, I know like iCapital evolved to a point where I think the software was valuable to the institutions. So it's not necessarily that the platform, the retail platform expands, it's that the tech becomes more applicable to an institution to use on their own.
Yeah,
Okay.
but let's print some positive cash flow along the way to help support that process, right? And I think that's the beauty of the business that we have. It's multi-pronged and not one side is going to dictate or drive everything. And so there is, again, a stability and a foundational layer here to fall back on to be able to continue to drive the future of the business.
Okay, got it. All right, Nelson, the last two questions.
Sure.
One is, can you tell us about I have a feeling I know the answer to this question, a person who has had a profound influence on you?
I'm assuming you think it's my dad?
Yeah.
Yeah, fair point. No, it is definitely the case. I think his rule of thumb to me when I was younger was like, if it's under $1,000 and you're not going to throw away in 2 weeks, I'll probably buy it for you and you can go tinker with it, right? And I think that was very formative for me to be able to just say, what am I personally interested in? Like, what actually drives me? And to be able to try all those different things, to figure out what I like, to learn more about myself along the way was super important. And I think him going through what he went through to start the company and with his friends and grow it and scale it the way they did, it was telling me that like taking risks is okay. Like being able to live through that process. I think this mantra that I've lived by was born from both, I think, seeing what he went through and also what I went through with a consulting company. But nothing's ever as bad as it seems. Like it'll be all be okay. But actually, nothing's ever as good as it seems either. So don't get too high up on what's going on because it can all come crashing down very quickly, but not as badly as you think. So those two together actually work really well to keep you just level-headed along the way. And I think a lot of that was driven by, again, just my father and seeing what he did and how he built that company.
Excellent. Last question. Can you tell us about a charity cause or other endeavor that you're passionate about? Obviously, we know it's not travel.
I still love to travel, but I don't identify with it as my only thing.
Right.
So yes, I've been involved in nonprofits, many of them over the years. I think it's always important to give back if you're able to, either in time or in money or both, right? So one that I've been supporting for years is one called Yamba, Malawi. And so for those who don't know, Malawi is literally one of the poorest countries in the world per capita. And this organization has been there for such a long time at this point, like multiple decades. And they've been able to really transform how families and their children grow up, how to educate them through changing the trajectory of the financial foundation for the family, right? So like they can say, for example, Malawi, big on back in the day, tobacco, like all these things that are really not great crops. And they switch them over to like soy and honey. And so they have a lot more they can do to grow the actual financial freedom for the family, and they can bring that down to get better education for the kids. And then overall, everything just improves along the way. So fantastic organization. I've seen their work and it's been wonderful to just be a part of that story. And then also a more recent one is one called Womankind, and that's more in New York. So it's actually right in my backyard. And they focus just on domestic violence of all kinds, right? And so I think such an important thing to talk about that I think doesn't get talked about nearly as often, especially in large cities. And to be able to see the work that they do and basically give a shelter and a home, and then also get them back on their feet and back out in the world has been amazing just to see and witness. And so huge fan of that. And again, it's just balancing out things that are local to me and things that are international. Having a little bit of both has been wonderful. So huge fan of both organizations, been a longtime supporter and would want to continue that, but it's been great.
That's awesome. And we'll put links to those organizations in the show notes.
Thank you so much. I appreciate it.
Absolutely. Well, Nelson, I want to thank you again for taking the time to chat with us today. This has been a wonderful conversation.
Thank you. It's great to be here.